Hi, I'm Kara Murphy, and this is Money with Murphy. For investors, 2026 began on pretty solid footing. Stocks were largely in an uptrend, supported by steady economic growth and improving corporate earnings. That changed quickly, though, as tensions with Iran escalated, disrupting oil flows through the Strait of Hormuz. Oil prices in turn surged, volatility picked up, and stocks sputtered into quarter's end. Energy is really what drove the turn. Oil prices had already been rising on the risk of conflict in the Middle East, climbing from about $60 a barrel to over $70 a barrel in late February. When bombing began and tankers could no longer leave the region, prices shot even higher, reaching nearly $120 a barrel, the highest level in nearly 4 years. Those higher prices in turn pushed up gasoline costs and threatened to raise expenses across the economy. That surge in energy prices quickly reshaped expectations for Federal Reserve policy. As the year began, inflation appeared to be cooling and markets anticipated 2 or so interest rate cuts. But those rising oil prices reintroduced inflation risk and in fact narrowed the Fed's path. Equity leadership also shifted during the quarter. Most of the market's gains over the past 3 years have been powered by large cap technology stocks. But in the first quarter, the picture began to change. Small cap stocks edged higher, with the Russell 2000 up just about 1%. Meanwhile, the technology-heavy NASDAQ fell about 6%. Meanwhile, value stocks outpaced growth by a wide margin. The rotation reinforced a familiar lesson. Diversification doesn't prevent volatility, but it can help investors navigate once that leadership changes. Remarkably, corporate fundamentals remain quite strong. Analysts expect the S&P 500 to post the 6th straight quarter of double-digit earnings growth. In fact, even with this geopolitical uncertainty, earnings estimates continue to rise. Revenues among companies are largely growing and profit margins have held in. Economic data has also offered support. Manufacturing, for instance, improved early in the year, with the ISM Manufacturing Index moving back into expansion territory. That shift helped more cyclical areas of the market. Industrials, on average, gained about 4% during the quarter, while materials and utilities also started the year strong, up roughly 10% and 8%. Fixed income faced a different sort of test. Those higher energy prices in turn lifted inflation expectations, which then pushed up short and long-term yields, weighing on bond prices. At the same time, investors grew cautious about potential credit losses. Credit spreads widened and high-yield bonds slipped. The pressure was modest overall, but after a strong run last year, bonds ended the quarter largely flat. Non-US stocks also felt the shift. Earlier in the year, before the conflict escalated, international markets had been outpacing their US counterparts, with emerging markets leading the way. That leadership reversed as oil prices surged. Sharp energy price increases, and in some cases outright rationing, pressured growth abroad and pushed international stocks lower. So where does that leave investors as we move into the second quarter? Geopolitics remains a key variable. Oil prices and what they mean for inflation will shape expectations for monetary policy and really drive near-term sentiment, keeping volatility elevated. But history does offer perspective. When looking across more than 40 major geopolitical shocks since 1940, market returns have typically been muted early, but then have improved over time, strengthening in the next year or two. It shows that markets tend to absorb shocks, adjust, and then move forward. And that's really where diversification and discipline matter most, not by avoiding volatility, but by staying positioned when the recovery takes hold. Energy prices, inflation, geopolitics, they'll continue to influence markets and shape policy expectations, and even drive short-term volatility. But beneath the noise, earnings are growing, manufacturing's improving, and market leadership continues to broaden. We'll continue to keep an eye on things, and until next time, invest wisely and live virtually.